Hello and welcome to episode 437 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, actually. Feeling much better as the weeks go by after being off ill and having my surgery, all these things. So I'm in a real positive mood. I won't mention football. Actually, we've not mentioned football for a long time on the podcast. There was a point when we did mention it, but obviously being a huge Tottenham fan, we were on a dizzy kind of run, which was brought to a crashing end on Monday night. So we won't mention that. Obviously, I was there because I go to the home games. So I've enjoyed the run, and obviously I'm now back to reality with everybody else.
Do you know what? I will briefly mention, because people go back in time and listen to these podcast episodes. So when people listen to this, perhaps in a few years' time will have passed and people will be wondering what we're referencing. So just to help those people, Google Tottenham versus Chelsea, November 2023, and you'll see why Damien's kind of not wanting to talk about it.
You'll just see an epic car crash and something imploding. But yeah, so I am good. And this week is Talk Money Week. So it was interesting because the team mentioned, they said, it's Talk Money Week, and it's an initiative to encourage people to, as the name suggests, talk about money. Are we going to be doing anything in particular? And the odd things we're doing on the social, but clearly we talk about money every week because we do the podcast. So it kind of links nicely onto one of the pieces we're going to do this week about debt, actually, and the importance of talking about money and sharing our experiences, good and bad, because in that way it helps people to overcome some of their problems and actually learn from each other, because that can help bring down the barriers for people and also the problems of inequality. So taking that, I'm going to tell you straight away what's on this week's podcast. So the first piece is a piece that was inspired by the idea of talking about money, but we haven't done anything on the sort of psychology of money for a while. And I thought, do you know what, it'd be quite nice to do something. But also it was inspired by something that me and Andy shared in the past and something that Andy's been reading. So there's a piece on how to get out of debt the easy way. I'm then going to do a piece on investment trusts, and in particular about the discounts and premiums. It's a question that comes up. If you do invest in investment trusts, you will see something called a discount or a premium. And what does that mean? And what is the impact for investors? And the final piece on the podcast, Andy's going to be doing something on energy.
That's right. I'm going to be doing a short piece on energy, and Money Saving Expert has announced some figures this week based on their own research to do with the demand flexibility service. Now, this was something that took place over the winter months last year, and it's going to happen again this year. And it encourages people to turn off their certain devices that sap energy at high usage times, and the energy companies reward customers for doing so. So I'm going to go through the numbers, work out roughly on average what people could save if they did it this year and whether it's worth it.
So it will be interesting to hear those figures, because last time around when the scheme was in place, I used it and mentioned it on the podcast, and there were quite a few people who questioned almost some of the numbers that I'd achieved and said they didn't achieve anything like that. So it'll be good to hear the research that's taken into account a wide cross-section of the population and what they've actually achieved under the scheme or what they could do. So I'm going to jump straight into the first piece, and there's something about it that kind of links back to when Andy and I first knew each other. So every so often you read a book or you come across something in life that has a real material impact and changes you for the better. And many moons ago, you've got to think that Andy and I, when we first met, and it was 20 years ago, and we probably, if you'd met us at the time, probably found us in the pub more often than we probably weren't in the pub, and you probably would have seen us drinking and smoking quite heavily and enjoying ourselves and having fun. And as time goes on, you grow up and you start to think that you don't want to do these things anymore. And don't forget, these were the days when you could smoke in pubs, and you decide you're going to give up smoking.
And this was pre-relationships, pre-children. We had nothing better to do effectively after work, and the pub was right next door, and it was convenience. And obviously we like to sort of catch up over the football.
Yeah, so it's like those good old days, some people refer to them as. And it was a period after which you grow up, and then we decided that obviously you want to give up smoking because it's bad for you. And at the time, I tried different ways, just pure willpower. I didn't do patches or anything like that, but I can't remember how I came across something called Alan Carr's The Easy Way. And it's in reference to a book that you read to help you give up smoking. And when I say Alan Carr, it's not the comedian, it's spelled differently. It's Allen and Carr Carr. Now, the book was in some ways life-changing because by reading this very short book and smoking while you read the book, by the end of it, you will have given up smoking. Now, it doesn't work for everybody, but given that it worked for me and it worked for you, didn't it, Andy?
It did, yep, absolutely.
And it effectively uses an element of psychology and reverse brainwashing in a way to help you overcome addictions. And the reason it's relevant for this podcast is because Andy's been reading another book from the same author in relation to sleep.
Yeah, that's right. And not that I have a problem with sleeping, but I was in the bookshop anyway. We were actually at a book signing, and they're very clever the way they do it. They snaked you round the bookstore, and it was in the corner there, sort of shouting at me. And it was Alan Carr's Easy Way to Better Sleep. And while I don't have trouble sleeping, I probably don't sleep enough. I don't prioritise my sleep. And I thought, do you know what? I could probably read that and get something from it. So I bought it, started reading it, and there were so many similarities to the smoking book, the psychology, and just common sense. And I love the book, and actually since reading that I've gone an extra 2 or 3 hours a night extra sleep, and it's pretty good stuff.
So we were talking about this in the office, and I said I didn't realise that they'd done other books. I thought it was really just around the sort of smoking and drinking. There's another one that they do in some other addictions, and there is actually one around debt. So it's how to get out of debt. And the book, the original one on smoking, is a book that I recommend to lots of people. So there aren't many books that you come across in life that you really do think have a material impact and change your life in a certain way. But this was a book for me where I was able to give up smoking, and Andy said he's used it as well. And the idea that they had one for debt, I found incredibly intriguing, therefore. So what I've done is I've read the book, and we're going to do a piece on the podcast which is going to just sort of explain what the book talks about, because it's a different way at looking at the debt problem. So there'll be people here listening to this podcast who may have debt, they want to pay it off, and rather than berate you about you should know better, it's the same as smoking, telling somebody that they shouldn't be smoking. They know that it doesn't work for everybody. They won't necessarily give up. Let's be honest, cigarettes are hidden behind counters that you can't see, and they now have pictures of diseased lungs and things like that on it. And if it was pure fact that would drive people to give up smoking, there wouldn't be smokers. It just shows that it doesn't work for everybody. So sometimes just telling people how to get out of debt is not enough. It's not going to be for everybody. So to give you a one example where you can do things differently, and it's about psychology. If you recall, we talked about clearing debt in the past before you invest. So you have the stages to become financially independent, and we'll put a link in the podcast actually to a past episode that was incredibly popular. We talked about it, and there are different ways of doing it. That you need to get rid of debt before you start building up. Emergency funds is one method, or start investing. And there was a guy called Dave Ramsey in America who is a kind of a financial guru. Well, he's a bit like us, to be honest. He's got a podcast, everything like that. And one of the methods that he has about becoming effectively financially independent, he says you should have a £1,000 buffer put in place before you clear your debts, because it breaks the cycle of using debt. And the idea being that therefore if your car tyre blows up and you need to repair that, you're not relying on a credit card, you've got the money to spend on that tyre, and then you can fill that fund back up as you get the money from your next pay packet, avoiding running up any more debts. And that way you do break that cycle. But Alan Carr's book takes a completely different view, because with his book and his way of helping people to get rid of debt and overcome that is to actually break the psychology of it and why you do it. Why do you have debt? Why do you spend lots of money or more money than you have? Which just by having £1,000 buffer, it might break the cycle of why you're immediately spending. But if fundamentally you are somebody who's going to keep spending all of the time, there's a deeper rooted problem. So the books tend to, whatever the addiction, they tend to work by following a set methodology. And one of the parts of that methodology is that you shouldn't question what you're reading. You just read it with an open mind. And you've read them, Andy, and they're quite hypnotic in the way they're written.
Yeah, that's right. And to be honest, that is the fundamental part of the book. That is how it works. It works by repeating the same message, asking you to be open-minded, and then slowly but surely it helps to, it's like an onion. It peels away the layers. It starts to break down the things that were causing the problem in the first place, and it starts to make sense. And if it only did it once or twice, or only covered the same things once or twice, I don't think the message quite gets through. It's the fact that it keeps going on that same theme and message that eventually you get it.
Yeah, and so don't forget they have different centres around the world where people could go and get help with different addictions. And what they do is allow you to understand that spending in a way that you do it when you accrue lots of debt is effectively an addiction. You have an addiction to spending money. And so he calls it junk spending. And the initial chapters of the book look at the misconceptions around debt and spending. It emphasizes that overspending is an addiction fueled by an illusion that spending brings pleasure, an idea that's perpetrated by like large retail companies. So you've got to think, when you look at the TV, you have adverts, magazines, whatever, there are products being pushed at you that are associating certain things. They're using an element of brainwashing to associate ideas of pleasure with their product. So the product fundamentally may not be a product that's a positive to you. So they even give examples in the book, things like chocolate bars. So it may be that the idea of the chocolate bar that they present on a TV advert has all sorts of other things about relaxation, people in baths. It has this scene. It sells you an ideal that you therefore want to be associated with, but fundamentally a chocolate bar is something that's high in sugar and very bad for you. So if they just told you what the product did, you wouldn't buy it. What you're actually selling is not the product, they're selling an idea. And you think back about cigarette adverts, alcohol adverts, they don't necessarily sell you the product, they're selling you this ideal. And so what you're doing is you're getting brainwashed about the things that you don't need, so you go and buy them. So it's a bit like that phrase, you buy things you don't need to almost ultimately impress people you don't even like. So the process works by showing you this brainwashing, and it kind of reverse brainwashes you. So it starts to show that this is what is happening to you. This is why you spend lots of money on junk spending, buying things that you don't want. The problem is actually your belief that you will feel better by buying something. And there's some really good examples in the book that they give. There's examples of an idea of, say, a father has a child and the child just wants their dad to play with them, but the dad is busy, and what the dad does, because he feels guilty about that, he therefore goes out and buys a toy for his child, and the child therefore is momentarily happy with that toy, but eventually throws it against the wall, throws a tantrum, breaks it, because all the child really fundamentally wants is attention and love. But the dad then sees that, gets angry, there's a big blow up, and he feels guilty. So what he does is he goes out and buys another better toy, and the child therefore likes that toy, feels positive for a moment in time, and it goes on and on and on, and you get into this cycle. But fundamentally what's happening is the dad is spending money because he thinks the spending is going to ultimately produce some sort of pleasure and solve problems. But really the problem is the relationship with his child and the fact that he's working, and what he really should be doing is thinking about the things that are free in life. And so he ends up having a spending addiction effectively by doing something repetitively because he believes it's going to make his life better. I want to give you an example I remember from the book regarding smoking, and they do use the same analogies in the one for debt. Is that, let's say everybody who doesn't smoke have a score out of 100, they feel 100, so they're at a normal level, they feel good. When they then smoke, they might feel this kind of bit wonky immediate sort of pickup or whatever it might be, but after smoking their score drops to a 95, but the initial buzz they got from taking that drug, that nicotine drug, therefore made them feel kind of good. So what happens if they were to be honest, if they rated themselves out of 100, they've dropped down a bit, and then what they do is they try and therefore smoke another cigarette in an attempt to effectively feel that real buzz again. But what they're really doing is trying to get back to 100. But then after they smoke that cigarette, as they smoke more and more, if they gave themselves that score out of 100, they'd be down to about 90. And so they smoke a cigarette again to make them feel better, but it only gets them up to 95. But then after the come down, they go down to about 85. And then they smoke another cigarette and they get up to about 90. Effectively, what you're doing is the same as somebody who would wear a really tight pair of shoes just to get the relief, that moment when they take their shoes off. So when you have an addiction like smoking, it really only makes you feel worse. You get back to a level that's not even the same as somebody who isn't a smoker. So you are under this illusion. And in debt, it works in the same way. By overspending, they talk about it gives you this brief moment of feeling like somebody who doesn't have any debt. So it's an illusion of pleasure. So the reality is you're using debt to get the feeling of somebody who doesn't have debt, what it would be like. And it's just an illusion because you're accruing more and more. You're going to keep buying things to give you that feeling. I'll make myself feel better. I'm going to go and buy something in the shops, whatever that may be, that retail therapy. But you're getting further away from that feeling of normality, somebody who doesn't have debt. Like the smoker, the more they smoke, the worse they feel. They feel like they're getting better, but they're in a cycle.
And what's really clever about the book is by the end of the book, book, if you've read it correctly and you've understand the techniques, is it helps to teach you to change that feeling of pleasure. That feeling of pleasure comes from not spending. So using the smoking as an example, when you get those what are called cravings or pangs that you get, and you get that little monster inside that's desperate for a cigarette, and then you cure it by having a cigarette, what you're able to do in the smoking book is cure that feeling of emptiness and like itchy craving. You cure that by reminding yourself that you're not a smoker and that you don't need it. And it's a really clever bit of psychology that you are able to actually cure yourself purely by understanding that you no longer need what you thought was the problem. Do you understand?
I mean, I totally understand, because obviously it cured me of smoking, but it is that psychology. Because even now, going back all those years when I read the book 20 years ago, I can still remember the idea of like, yeah, but when I smoke that cigarette, I'm actually going back down to like a 95 and eventually going lower and lower and only just getting back to a level that's much lower than somebody who doesn't smoke. The analogy of walking around wearing overly tight shoes all day long just to get the feeling of, that sort of illogical concept is effectively what you do when you smoke.
And using the debt idea then, where you can hopefully read the book and then understand that your behaviors are perhaps the problem, whereas normally you would then spend to make yourself feel better. Once you understand that that isn't truly the case, hopefully you'll get the feeling of pleasure by cutting that off, understanding that that was what the problem was, and then actually getting pleasure from looking at a bank account and thinking, well, there's 10 or 15 pounds sitting in my bank that I wouldn't have had previously because I would have spent it. So you get the pleasure from the saving rather than the spending element.
Exactly. And the book doesn't berate you. It does shine a light. There'll be things about it that you might feel a little bit uncomfortable, but go with an open mind. The concept is quite interesting. For some people who aren't able just to go kind of cold turkey when it comes to debt, this might be something that might be helpful for them. And so what it does, it also starts to help you understand that aha moment. Yes, this is how the world works. This is how retail works. This is how marketing messages work. A good example, I've always talked on the podcast about, I think credit cards should be rebranded as debt cards. And funnily enough, he actually uses that same phrase in the book. And the idea that a credit card doesn't give you control. There's an idea that you've been sold that credit cards give you the ability to take control in the world because they give you the ability to buy things. There's always a positive connotation. But what you're really doing, as soon as you have a credit card, you're giving over all control you have of your finances to a debt company. So a credit card company, they dictate how much you can spend. You have a credit card limit, for example. They dictate where your income goes because things cost more if you buy them on debt, because don't forget they add interest. So it starts dictating how much you pay for things, and it therefore dictates what you can afford and what you can't afford. So the idea is that it starts to make you look at the world of debt very differently. And I think people who've come through that journey of having lots of debt and clearing it, they end up there. They start to realize the traps that are there for people. They don't give you debt because they like you. They give you debt because they want you to get into one of those spirals. It's like when you see these nature programs when there's a plant that's laid a trap effectively for a fly to go into, and the next minute the fly's got stuck and has ended up basically falling inside the nectar or whatever it is in a plant. They use the analogy in the book actually, and it ends up effectively getting eaten alive by the plant and dissolved. And that idea is the sort of Venus flytrap. We see it throughout finance. So it starts to help you look at that problem and understand it. So in the end, the book does come up with practical steps, but the thing is, we provide lots of practical steps. You can see lots of practical steps of how you clear debt. What this is interesting is because it helps you understand the psychology of what's going on and how you can therefore overcome it. But one thing I just want to point out, I know a lot of people like the idea when I've talked in the past about spending plans rather than budgets. So if you look at the idea that a budget can have connotations being quite negative, so you're depriving yourself of something, the book starts to reframe a lot of things. You realize that actually by clearing debt, you're not depriving yourself of anything. You're actually now giving yourself control, and it's a positive thing. You're making positive choices. And what it means, you can start to spend money on the things that make you happy. The book starts moving into the direction about happiness. What does it mean? It's not about the things you own. It's about the things that you often do, the things you enjoy. It starts making things positive. It gives a very, very good example of how a day a guy has where he goes to meet a friend. He starts becoming stressed about the amount of money it's costing to go for this meal, and and when he goes there and other people are ordering rounds of drinks, and he basically ends up a miserable day, ruins his friend's birthday. Fundamentally, it comes down to the idea of his view of money and the debt that he had. Had he viewed the same day in a different way, where it was much more positive, it's about, I'll get to see my friends, and he's already been in control in terms of, I've got money to spend on this event, that kind of thing. Seeing the same day in two different ways, he looks at it saying that if you gain control of your debt, what you're really doing is allowing yourself to spend money on the things you want to do, which would be going to see friends or doing things, and not feeling bad or worried about doing that because of the debt pile that you've got that's partly a result of the brainwashing you've received from marketing, the tricks from the credit card company. So overall, we've talked a lot about the book, and you might sit there and think, God, it's almost like an advertorial for it. It's a different process, but it was a book and a process that did have a material impact on me for giving up smoking. Same thing for Andy.
I'll happily say as well at this point, Damien, I used it to give up drink as well. I was a heavy drinker. I used to drink in the bars of London. I used to work in the city. And I made a decision that with a young daughter and a full life ahead of me, I should perhaps tackle that. And I did it through the book. I wouldn't have considered myself an alcoholic, but I was a habitual drinker. And I just used the steps in the book. And since I read that book, I've not touched a drop of alcohol. So it is actually a life-changing book for me personally. It's not an advertorial, but I don't mind giving it some time on the podcast.
Yeah, and so we're going to put a link to it in the show notes. And one of the key things about the book, it's about talking about money, and it's about talking about things more openly, because then you understand you are not alone. This isn't a safety in numbers exercise. By sharing, you start to realise what is really happening out there, the brainwashing that's going on, and the things that you can do to counter that. And the thing that talking about money also does, and the book alludes to it, is that you realise these problems are universal. So just because people are rich or a lot richer than you doesn't mean they haven't got debt problems. Their debt problems are just probably a lot bigger, because there are a lot of people who live beyond their means and they've got lots of money, and yet they have huge amounts of debt, and then sometimes it can all come crashing down. So it starts to make you realise that situation. And the real thing is, it makes you think about taking positive action, and that process of reading something that's going to start to help you move in the right direction. And it's like the old proverb of every journey of 1,000 miles starts with a single step. So if you found this useful and you do end up perhaps using this book, or you have other ideas or ways that you've managed to conquer debt, then please do share them. And it could be you share them in the Facebook community. There's a brilliant question in the Facebook community that I want to jump on and actually put my own view on. Somebody asked the question this week, what piece of financial advice would you give your 27-year-old self? Which I think is a brilliant question. And I think now some of us are older and wiser. I think there are definitely a few things I would have told myself back then, and that would have included topics such as debt. So it'd be great if more of you could jump onto that and leave your comments, and maybe we will do it as a piece on the podcast, because I think it's a fantastic discussion.
Okay, so let's move on to the next piece of the podcast then, Damien. We're going to be talking about investment trusts and discounts. So you got a piece on this?
Yeah, so investment trusts, if you go and invest in investment trusts, you're very quickly going to come across something called a discount or premium. And so I want to just run through what this means, what is the impact for investors, pros and cons, and whether you should buy at a discount. So thinking about an investment trust, the structure is different to a unit trust. It's essentially a company structure where the company invests in assets. So you're effectively buying shares in a company. So those companies are usually floated on the stock exchange, and that company will invest in those underlying assets. So that means that the assets that the company might invest in, and if you go and look at an investment trust, it can be all sorts of things. It could be UK equity, so it could be other companies out there. The net asset value is the value of the underlying assets that they've bought in totality. So you might think, well, the share price of that particular investment trust that you're looking to buy is just going to be equal to the underlying value of those assets. But that is usually not the case. The share price of the investment trust can be higher or lower than that net asset value, the NAV, NAV. And that discount or premium will obviously affect the price that you pay for the shares of the investment trust. So it leads on to that question of, should you buy an investment trust at a discount or premium, and why would that occur? So the reason that you might get a discount on an investment trust could be market sentiment. So it could be investor sentiment towards particular sectors or the manager of that particular investment trust. So they could be sitting there thinking there's some reason they don't value that manager, or they think the value of the assets that they're holding is actually lower than they're reporting for some reason. A good example, they could have some unlisted shares. And the problem is with some unlisted shares, it could be private equity, for example, the valuation will be based upon the last known transaction. And so the value that may have been applied to that, the market might actually think, do you know what? Things have changed. I'm not sure that value is still correct. So we're going to probably price it a bit lower. So they're not willing to pay the full price, like the NAV value for that particular investment trust. So that could drive a discount, for example. And usually discounts can be for a short period of time, but they can last for years. And so the other reason you might get one is past performance. That can influence the discount or the premium. So if an investment trust does really well, then what will happen is that people might decide if it's done well, they want to invest in it. Now, with investment trusts, it's not like unit trusts where the manager creates new units to effectively allow people to buy into the fund. So those units are created and those people buy those units and then their money is invested. With an investment trust, there is already a stated number of shares. The number of shares doesn't change. So therefore, if people want to invest into that investment trust, they have to buy shares that are already in existence. So they will buy them from existing investors. In the same way as you would do ordinary shares, you would buy and sell on an exchange. So therefore, if there's a big demand for them, because people might be looking at the performance of that investment trust, say, I want to be part of that, I want shares in there, they're therefore going to have to pay more for them because it will drive the price up. Just like if you go and want to buy shares in any company out there, if there's a greater demand, then there is supply, the price goes up. So that's why we see the price movements. Equally, it could be that the performance hasn't been great for that investment trust, and there are more people wanting to sell their shares in that investment trust than people want to buy them, so it causes the price of the investment trust to fall and therefore deviate from the actual net asset value of the investment trust. So you can also have discounts because of liquidity issues, so the size of a fund, so that can start to cause funds to trade at a discount. I'm going to come on to something that explains that a little bit better in a second when it comes to what managers do about discounts. It can be overall market trends, it could be they invest in particular sectors, it could be infrastructure, for example, and the market appetite for that particular sector, exposure to that starts to fall, and that starts to impact the share price of that particular investment trust. So you're in this scenario that you've got two things to think about when you're buying investment trust: the underlying net asset values, the assets themselves, but also the share price. So there can be positives of buying at a discount. So I'll run through some of the positives now. So there is the potential for you to get value because you are effectively paying less for the net asset value of that particular investment trust. So you could have, for example, the value of the underlying holdings go up within the investment trust. So that can be a performance driver, but you could also have a narrowing of that discount. And in fact, it could go into a premium. So therefore the price of these shares could go up as well because the discount is narrowing. So if that happens, it's going to boost your returns. I mean, there can be a potential for higher yields as well. And this is the thing I don't think a lot of people realise, that the dividends paid out by investment trusts are based on the NAV, so net asset value. But if you're buying shares at a discount, then your yield is going to be higher. Of course, the opposite is true if you're buying shares at a premium. So if your shares in the investment trust you're buying, you bought them at a premium, then the yield could be impacted. So that's quite a positive for income investors. And of course, it can also be an opportunity for you to do a bit of active management, because you might be interested in a particular area of the market, sector, exposure to certain themes, whatever it might be, and you go and buy an investment trust deliberately that's at a discount because you're hoping that it's going to narrow at some point as well, because it's a theme or something you want, but you're getting it cheap.
So there's a double element there to someone who's looking primarily into areas at a discount, purely to take advantage maybe of that then increase in the future, but they're going to get that yield sort of kicker as well. So there's a double element there for those value hunters.
Yeah, and so it does make it a potential trap, like a bit of a minefield. You've got to have to do your research. And of course, that's one of the cons of it. There is that potential for a value trap, because you could buy something at a discount and there's fundamentally a reason for it being at a discount, and that discount could widen. It could be poor management, for example, and that's why it's a discount. Or it could be undesirable assets that they're investing in. So there are assets you buy into it, but actually the things that they're holding aren't particularly desirable, and it could be down to things like private equity, some of the unlisted shares. Don't forget, investment trusts also have leverage, so they can borrow money to invest. So that is another thing to factor into all this. So the volatility you get in the share price can be an issue as well, because you're going to have more volatility because you've got two moving parts. You have that NAV, but you also got the discount or the premium potentially in that swing. So that is something that can be a con to investing in investment trusts.
You mentioned private equity a couple of times there. That seems to be a little bit of a trap potentially for people. Is there an easy way to spot how much private equity there is in it?
You should be able to see all the information on the fund fact sheets. So that's the key thing. You've got to do your research on anything you want to invest in. So you should be able to find that information anyway. The other thing I want to go on to, though, is there is that risk of wind up as well, because if you think about it, if the discount became so cheap and the net asset value is obviously much higher than the share price, there does become a stage where you may as well wind it up and return the money to investors effectively, wind up that investment trust. But unfortunately, you can't make that happen individually. And the other thing to bear in mind is if you are ultimately forced to exit in this way, that can create a potential sale at an unfavorable price. It can create a tax liability as well. So these might not be likely, but they are distinct possibilities. There is the other issue: if people are trying to sell, it will drive down the price, so the discount can widen. So the discount itself can start to become a problem for people who are trying to sell their shares. And one of the other cons is something that I'm going to come on to now about the management and what they can do about it, is the cost of taking action. So managers can sometimes take action to narrow the gap. So trading at a discount isn't necessarily an issue, but over the long term, managers may want to try and bring it in and narrow it. And some of them have policies. So let's say, for example, the discount gets to a certain point, they automatically trigger actions that will try and narrow that discount. And that can be done by things like buybacks. So they may sell assets and then use that money to buy back some of the shares that are out there in their investment trust. And so by doing so, you reduce the number of shares in existence, and therefore it will drive up the share price. So that is something that can be triggered automatically by some investment trusts, but it could be a decision they make as a management on an ad hoc basis. And the issue with that is that when you're smaller, that can start to increase costs in doing that, and it also starts to cause the fund to shrink in size in terms of the asset value, and that in itself can also lead to the potential for things like wind up. Now the other thing is, of course, if shares are trading at premiums, managers could do the opposite, and they could issue more shares to try and bring that down to make their shares more attractive. So there are things that managers will try and bring it down. I think the discount is more likely to drive some sort of management action, but you will get cases where they will issue new shares because obviously the demand for that particular investment trust. And don't forget that the overall performance of an investment trust will be partly determined by the movement in share price, but the net asset value as well. So they are going to be looking at their share prices. And the other thing they could do, of course, is to try and change the assets within the investment trust as well. So you've got to think the discount is the price versus the net asset value. So you could try and change the portfolio itself. Overall, if there is a policy for a well-managed investment trust that manages the discount, and it will tend to move towards the long-term average over time. So it will tend to move towards that NAV. So it is a positive thing, but you have to look out for it. Now, there can be issues for investors. We mentioned it before. There can be capital gains that can be caused by some of the actions. You have to look at the fact that when you buy at discounts and premiums, is the income impact. If they start to try and reduce that discount, then that will have an impact on the potential yield for investors who are going to new investors I'm talking about. Again, volatility, you're going to start seeing volatility in the price of that investment trust. And of course, if there is a discount or a premium and there's a management of that, that could influence an investor's decision of the timing if they want to try and exit from it. Because let's imagine if there was a big discount or a discount was winding, somebody might not decide to sell at that point. So the management of any discount or premium could start to impact the decision of investors when they might want to sell, because like we said earlier on, that has an impact on the performance from the investor's perspective of that particular investment trust. So it's something that I think is quite interesting and people haven't thought about. So just for completeness, I just got to talk about the pros and cons of a premium. So if you buy a premium, that could be an indicator of strong performance, not necessarily, but often, and quality management, and you could see some volatility in that share price because you're paying a premium. If that demand starts to evaporate, you could see the share price drop even though the net asset value hasn't changed. So that's a possibility as well. And of course, we talked about it earlier, the reduced yield if you're going to invest in an investment trust at a premium. So from an investor's point of view, obviously when you do your research, you want to be looking at the investment trust you're going to invest in. You want to look at whether there's a discount, whether there's a premium. You might want to see if you can find historical records of what they are. You might want to look at what others in a similar field have a discount or premium, because don't forget, it could be partly because of the market sentiment rather than actually anything fundamentally to do with that particular investment trust. So you want to do your research, work out why potentially it might have a discount, but also over the long term, you have to realize short term, there could be some fluctuation in these prices that could hurt investors. But investment trusts probably are quite well suited for people holding them for the longer term because of these sort of double whammy in terms of volatility variations, NAV and share price.
Okay, so let's get on with the final piece of the podcast then. We're going to be talking about something called the Demand Flexibility Service. Rubbish name. What it essentially is a way, well, it is. It's a way of saving money on your energy bills by taking some action, essentially, turning off your devices at key times when it's busy on the grid, and you can make some savings. And various different energy providers have taken part in this. And so the numbers are now in, courtesy of Money Saving Expert has done some research, and it's asked some of its readers to answer some questions about how they got on last year. So I'm going to go through and just do a whistle stop tour on some of these numbers, and then Damien, you're going to give some of the insight into what you experienced last year, and then we'll cover off what's happening this year and how people can take part. So there were 3,000 people that were surveyed, and the headline numbers really are that around about 80% of people said they loved it and they'd definitely do it again. So you could argue that that is a broad success. Payouts were particularly modest. 34% of people said that they earned £5 overall or less, with only 16% of people getting more than £20, and only 3% of people earn over £50. So people aren't going to be doing this and getting rich and saving hundreds of pounds off their energy, but it is free money at the end of the day. Just looking at the providers, because I know people may be interested, but can they take part this year? The providers that took part last year were Octopus, OVO Energy, British Gas, EDF, and Eon Next. There were some other suppliers as well, but they're the big hitters, if you like. They're the ones that took part. And generally, people save the most money with Octopus, OVO Energy, and British Gas. And so in terms of the total numbers, between November 2022 and April 2023, 1.6 million households took part in the scheme. And Octopus Energy had the largest number of people in that scheme. That was 700,000 people. And that's ultimately because Octopus opened it up to everyone who had a smart meter that were on their service. Now, what happened with the other suppliers is they kind of picked and choose who they wanted to do it. Some people got an email inviting them, some didn't. I know, Damien, you're going to go on to the fact that you were picked for British Gas, was it?
Yeah, so I was invited to do it. I think I had to say that I wanted to. And yeah, as you say, the numbers, everything you said there is kind of in line with what I experienced and what I thought it would be. The fact that, I mean, Octopus being the lead on this doesn't surprise me in some ways. The amount of money that was saved doesn't surprise me. I think, in the second tier. I think I saved probably overall somewhere in the region of probably about £30. But it did vary because of the initial part of the scheme. I actually saved a lot more actually at this beginning because they were doing like a double incentive. They would double any saving and give you that. So at the beginning, I very quickly found it easy to actually make savings. And in 1 month in particular, I think I made double digits. So it's just about altering your behaviour. I think there were certain things about whether you would use particular energy zapping devices, about whether you're going to be cooking at different times. I think they were the big impacts. I have to say that British Gas did then continue on another idea where they started to offer incentives if you started to not use as much energy on a Sunday. That was kind of brought in as well. So there are some innovations. Like you said, Andy, you're not going to get rich, but it's kind of everything helps. If you're going to be cutting your energy bills anyway by trying to reduce your usage, then if you're going to be doing it during these periods as well, it's only going to increase your savings effectively. So yeah, we'd love it to be higher, but it does go to show that it wasn't just me as an isolated person, but there are potential savings out there.
So if you have a smart meter and you're keen on taking part this year, most of the big suppliers are taking part again this year. So go onto your supplier's website and search for demand flexibility service or energy saving schemes, and you should be able to find the information. We've got a couple of articles on the Money to the Masses website, which we'll link to in the podcast notes, that talks about this and how it works for the major suppliers. We also did a piece last week, kind of tying in with the Halloween theme, that talked about vampire devices. Now, vampire devices are those devices that stay on standby and end up costing you lots of money. So Lauren updated an article with the figures we're in for this year, and I think some of the numbers will surprise people. So there's some tips there on how you can save money on those devices that you leave plugged in overnight.
So I think that's it for this week, Andy. We've covered lots: debt, we've covered investing, and of course we've covered energy there as well. So as usual, please do leave a review. We've not had a review for a little while on the podcast. I love you sending in emails to us, giving your feedback as well, so please continue to do that. But it would also be nice to put some of those on to the podcast app of choice so other people can read your reviews as well. Don't forget, we will be giving out potentially Money to the Masses mugs to some of those reviewers. As ever, do join the Facebook group and also look out on all our social channels, particularly Instagram, which is my personal favourite. And as ever, do subscribe to our YouTube channel, because there's quite a lot of stuff that we don't put in the podcast because it's quite timely. It could be best credit cards, it could be about the best incentives out there for switching banks. In fact, there is one out there, I think I mentioned previously, £205 you can get. Don't have to switch bank accounts, you can just get that as effectively a cash incentive to be able to open an account with this particular bank. You can find details on our YouTube channel. And also I've been talking about where interest rates are going to be going, because that changes all the time, and also house prices. So there's some quite interesting insights actually this time around on the future direction of house prices. Do make sure you subscribe to our YouTube channel as well. So Andy, after all of that, I think that's all that's left for us to say is until next time.
That's right, until next time.